So Cathie Wood is, of course, one of the most famous investors out there, very well known for her kind of aggressive, bullish take on stocks, with a specific focus on investing in disruptive technology stocks for the long term, which she invests in through her various ARK ETFs that she manages. And look, I may not agree with many of her individual stock picks, but I still enjoy listening to her and keeping up with the moves she makes because she's just kind of a fun contrast, I would say, to something like Warren Buffett, who mostly invests in reliable, safe, kind of boring stocks. Cathie likes to invest a lot more dangerously in more speculative stocks. And look, once in a while, she even finds a hidden gem or two out there as well. So I always enjoy listening to her and just seeing what she's coming up with and what moves she's making in the market. And her ETFs are of course very popular too. So anyway, in today's video, we're gonna run through the 5 largest stock purchases that she's been making here over the past month in her flagship ARK Innovation ETF. It's a ticker symbol ARKK. So these are 5 stocks that she is actively buying. I'm going to quickly break down each one of them, give you my thoughts on them, and I'll even rank them from best to worst based on my own opinion of each one of these stocks as well. So it's gonna be a ton of fun. I love doing these videos for you guys. And by the way, if you are enjoying the channel, please consider supporting me through Patreon to help me do YouTube full time. It's a great way of keeping this channel alive, and it also gets you some cool perks in return, like access to our own community Discord, where we can talk about stocks together every day. It's a ton of fun, and you get to share ideas with like-minded investors, and I just think it's an awesome thing. So I would love to see you on there too. But regardless, thank you for stopping by. Let's go ahead and jump into these 5 stocks that Cathie Wood is buying. Alright guys, so counting down here from smallest to largest purchases over the past month, coming in at stock number 5 is going to be a company called Verve Therapeutics, ticker symbol VERV, which Wood purchased about $6 million of based on recent share prices. Now, this is actually a gene editing biotech, which is pretty exciting given that gene editing will likely play a huge role in the future of healthcare. However, it also makes this a more risky stock than usual, given that the field is still in its infancy, with many treatments still going through trials and not released for commercial use yet, which means that you don't get much financial security with these type of stocks. In fact, I believe last year was the first year ever that Verve actually generated any meaningful sales, and all the meanwhile, their losses have been growing by staggering amounts each year, reaching over $150 million loss last year. Contrast that with the less than $2 million that they did in sales, and you're talking about one heck of a speculative stock here that is bleeding money at every turn. Now, it's not all bad news. In fact, Verve has some very promising single-course gene editing treatments down the pipeline, especially for cardiovascular diseases, including their Verve 101 gene editing therapy that aims to treat a severe hereditary disease that affects millions of people around the world and has already reached clinical trials. And if Verve's one-and-done gene editing programs weren't living up to at least some of the hype, then I don't think Eli Lilly would have invested tens of millions of dollars on one of them just last week. But for now, Verve remains one of the riskier stocks out there that, even after falling over 70% from its 2021 high, still carries a market cap of over $1 billion, leaving a sky-high price-to-sales ratio of more than 350. That's just too rich for a company that doesn't even have a single product out on the market yet. Trust me, I totally understand the value of buying a stock early on and waiting for the business to materialize over the long term, but I just think that there's safer spec stocks out there with still a tremendous amount of future potential too. So I'm gonna rank this one fairly low for now at number 4 until I see what else is on this list. Speaking of which, let's move on to the next stock, which is going to be Ginkgo Bioworks, ticker symbol DNA, which Cathie purchased almost 3 million shares of at an estimated value of somewhere close to $7 million. And funny enough, this too is a biotech type of company with a very promising future, and while their sales can rise sharply at times, they too consistently lose way more money on the bottom line than they even generate in sales, which is a growing concern and thus qualifies them to be a highly speculative stock as well. However, I'd probably still prefer this one over Verve for a couple reasons. For one, their business is a bit more established already and growing, which focuses primarily on two giant parts of the healthcare market, those being security and manufacturing. For example, their biosecurity segment has helped with things like public testing during the pandemic, while also working with the US government and intelligence agencies on national security projects like detecting bioengineered DNA that can be used to target and damage human populations. On the manufacturing side of things, their biofoundry segment helps businesses run more efficiently by providing biotech assistance. For example, they help the plant grower Kronos produce more cannabinoids by splicing the genes that can later be cultured through their bioreactors to produce giant quantities that Kronos can later use for their own products like edibles and vaporizers. It's all very impressive work, and it usually combines robotics, machine learning, and mass-scale biological technologies that are hard to replicate, thus ensuring a stronger barrier to entry and a competitive advantage for Ginkgo. It also means that they are likely to benefit from economies of scale over the long term. So while they're not profitable at the moment, that might eventually change into some pretty strong margins over time. Right now, all their sales are being put back into the business in order to grow and expand, like opening 13 new biofoundry programs last quarter alone, bringing the total up to 97, which is up over 50% year over year. And over time, these programs should snowball on top of each other as they're used across various customer needs, which I think will help them grow their profitability even further over time. And while the stock is expensive right now, I don't think it's as expensive as Verve's, with a much more reasonable price to sales ratio of around 10. The stock has climbed already more than 40% this year in what has been a pretty welcoming year to riskier growth stocks, but it is still down a whopping 87% from the all-time high, while the average analyst price target on Yahoo Finance thinks that it should be trading around twice as high. Again, it's very risky and I don't plan on buying it yet myself, but I at least understand the appeal for it a bit more, so I'll move Verve down one spot and instead I'll give Ginkgo the number 4 ranking for now. Alright, moving on to stock number 3, we actually have the first stock on the list that I also own a small position in myself, which is going to be Robinhood, ticker symbol HOOD, or Hood, which Cathie purchased another roughly $11 million of this past month. Now, the vast majority of you guys know this one, as it is one of the most popular investing apps out there, as they really pioneered things like commission-free trading and fractional shares, which forced other brokers to start offering the same features, since Robinhood was continuously stealing market share from them. And to this day, Robinhood continues to grow its user base, reaching a new record high last year of 23 million cumulative funded accounts. And one of the things I've always liked about Robinhood is that they continuously add new features and never really seem to get too complacent, having recently added things like IPO access, IRA with a 1% match and no employer needed for it, stock lending to make money on your already existing positions, more crypto trading, 24-hour access to certain stocks, and they're still working on even more features like the Robinhood wallet. Over the long term, this aggressive expansion mindset could help them drive growth, and even here in the present, I already think that Robinhood is one of the most streamlined, kind of buttery smooth platforms that I've ever used for investing, which I also prefer using over mostly anything else. By the way, I have never been sponsored by them either, I just really do enjoy using the platform. With that said though, there are definitely some major concerns. For one, their user base can vary wildly depending on market conditions, which is clearly evident by the monthly active user count that can sometimes skyrocket just like it did in 2021 up to over 21 million before subsequently crashing down to less than 12 last quarter. Financials are also consistently volatile and all over the place, with still a GAAP net income loss on the bottom line, and this year expected to see revenues rise by 37%, but then slow down to just 12% growth the year after. Now granted, last quarter sales did soar by almost 50%, and they actually became profitable on an adjusted EBITDA basis, but it's still all kind of a bit of a headache, I would say, to follow and keep track of their volatile business and their volatile financials. Meanwhile, the stock is also just as volatile, crashing by 85% from its highs, but then rising over 50% this year, but still carrying a rich valuation above a 7 PS ratio as well. That is, however, the cheapest valuation that we've seen so far on today's list, at least on a price to sales basis. So I'll give them some credit for that, and I'll rank them at number 3 for now. But like I said, it's still a pretty risky stock that I only hold less than 1% of in my own portfolio. And by the way, I actually think SoFi is a more attractive alternative, kind of all around investing and finance and other things kind of app that I would prefer owning over Robinhood much more. And I do own that one myself too. Okay, moving on. We are now down to the final 2 stocks. And coming in at stock number 2, it's going to be another pretty interesting pickup here in Twilio, ticker symbol TWLO, which Cathie purchased another $17 million of this past month. Now, if you've never heard of Twilio, they have a pretty unique business model centered around cloud-based communications where they help other businesses integrate chat, voice, and even video communications into their own platforms for things like customer service. And by integrating robust AI-powered features, they're also able to help them improve efficiency, collect and analyze customer data, improve their marketing, their connectivity and customer engagement, offer better customer experiences, help with e-commerce. There's many different things that they can really assist with. And so far, it's made them a very popular choice to partner with, as they already serve over 250,000 companies, including some giant and very well-known brands like Toyota, Duolingo, Dell, Yelp, Twitter, Lyft, Airbnb, Uber, eBay, DoorDash, Instacart, Shopify, and the list just goes on and on. It's pretty remarkable. By the way, all the meanwhile, Twilio has also been collecting massive amounts of data for themselves from all of these companies that they're using to continuously improve their own AI services even further. So with the rise of things like ChatGPT and generative AI, and just AI in general, don't be surprised if Twilio actually becomes a popular choice in that space as well. In the meantime, though, sales have been soaring every year, and I think they're likely to grow by double-digit rates over the long term too. But unfortunately, just like the others, this is yet another company here that Cathie Wood is investing heavily in that continues to bleed money on the bottom line. Still, following a nearly 90% crash from the top, the stock's valuation is actually pretty cheap now at a price to sales ratio of less than 3. That's the lowest of all the stocks that we've looked at today, and therefore I'm ranking them the highest at number 2. And I know that may seem a little weird ranking them ahead of Robinhood, given that I actually own a little bit of Robinhood stock myself, but I've also been thinking about buying a very small amount of Twilio recently too, so I'm still going to rank it higher. Alright guys, that's going to leave us now with the final stock of the list. Coming in at stock number 1, the largest purchase that Cathie has made recently has been in Teradyne, ticker symbol TER, which she purchased over $20 million of over the past month. And this one too has a pretty interesting business, as they are primarily a robotics company that specializes in the automation of testing and manufacturing of various electronics and other mass manufactured products with the use of actual physical robots. For example, they may be painting finished products or assembling packages or even driving around a warehouse fulfilling orders for e-commerce. And that's a market that I think will always be around, because you may be able to get rid of human workers to cut costs, but you're still going to need AI and robotics to take their place, as sad and as horrific as that sounds, of course. But it's just the reality that we live in, and I think it'll get larger over time. In fact, Fortune Business Insights estimates that the industrial robotics market alone will continue growing by a double-digit rate through this decade, all of which has mostly translated into pretty good results for Teradyne, as they are solidly profitable and even grew their sales by very large amounts up until last year, where they finally started to feel the effects of a weakening macroeconomy, as their sales not only dipped last year but are still expected to fall by another 15% this year too, until they finally return to that high growth that you would typically see from them in 2024. At least according to analyst projections. Speaking of which though, the stock is actually trading higher today than the average analyst price target as well, and is up over 30% this year right near a 52-week high despite all the recent challenges. And while they are technically the only GAAP profitable company on today's list, the price for those profits is still pretty rich too, at a 39 forward PE ratio, a 2.2 PEG ratio, and even a PS that is still above 6. It's a cool company and I like the business, but I'm not particularly interested in picking a stock up like this that is, seeing their business in decline and being so heavily exposed to the macroeconomy, yet the stock price has actually been rising. It doesn't really make a whole lot of sense to me, so I'm just going to rank them somewhere around the middle at number 3, and I'll adjust the others around it. But that's going to do it, guys. This will leave us with our final ranking. I put Twilio at number 1 by default, who I think is really the most attractive overall out of these stocks at today's prices. Robinhood is right behind them at number 2, who I think is mostly a hold, I would say, but I actually think SoFi would be a better investment. Then I would put Teradyne at number 3, which is the only profitable stock on the list, and then Ginkgo and Verve at number 4 and number 5 respectively, who I think are pretty exciting biotechs for the future, but they are still pretty risky at the present time. And so yeah, I am just personally not a huge fan of these pickups. I think given the uncertain economy, I find it very strange that Cathie is investing so heavily into high risk, speculative, unprofitable stocks. And that's not to say that these are necessarily bad stocks, but they are speculative stocks. And so if you're looking for spec stocks, then hit up Cathie. She'll give you tons of different stocks that you can look at, and I think it's great for that. But if you are looking for more reliable, safer investments during a very uncertain, kind of shaky time in the economy, then I would look elsewhere. That's just my opinion though. What do you guys think about these stocks? How do you feel about them? Do you own any of them? I'd love to hear your thoughts. And is there any other investor or hedge fund manager that you'd like me to review next, stocks that they're buying? Let me know down there in the comment section. But thank you so much for stopping by, my friends. I hope you're all doing well, and I will catch you in the next video. Take care, everybody. Bye-bye.